The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello and welcome to Property Investing Matters. It's great to have you on board for our almost end of year tax edition. And of course, who better to assist me with that than tax guru Julia Hartman. Now you may be sitting there thinking that I look a little bit different today, and you'd be right. Just some simple eye surgery, but certainly not enough to stop us going ahead with the show today. We have lots of questions already, and they've been forwarded to me via email or Facebook. And everyone who did send in a question will, of course, get one of my books as a prize. And this week, it is whichever of my books you would like. So be sure to go to my shop at destiny.com.au and read the synopsis of each book so you'll know which one is the most appropriate one for you, and we will then have that organised to send to you. Now, to get your copy, email a question to me at pim@mypropertytv.com.au, send it in a message on Facebook, or post it into a comment on my Facebook page, and then watch at the end of the show to see how to get hold of your copy. Now, for my guest tonight, Julia is a chartered accountant, and she's also a fellow of the Tax Institute. She founded Ban Tacs 30 years ago, and it now has 12 offices Australia-wide. The bantacs.com.au website has a huge amount of free material for property investors. All you need to do to get to it is check out the latest blogs ready for the year end, and there's also an Ask Ban Tacs service where Julia answers tax questions all on her Ban Tacs website. Now, tonight we're going to be looking at a number of things, including what you need to do before the end of the year, whether you need to register for GST, and also a bit of a warning from Julia about rebuilding an investment property. Plenty to get through, so let's get started. Hi, Julia. How are you going?
Good, thanks, Margaret. Thanks for having me on the show.
You're more than welcome. And of course, end of year, we always like to make sure that at the end of the year, we're ready to go with all of the latest advice. So what I've asked you to do for us tonight is to get together your 6 top tips for how property investors can be ready for that valuable end of the year tax return. And they need to, of course, be ready before the 30th of June. So what's the first tip that you can give us tonight?
Well, I'd say starting repairs before the end of the financial year, having incurred the cost if you're not going to rent it out the following year, because you've got to undertake the repairs in the year that the property produces income, and they've got to relate, of course, to the time that you had a tenant there.
Okay, so for those property investors then who might be thinking about stopping their rental for a period of time during the next financial year, you're suggesting that think ahead, get in there now. There's still a couple of weeks left before the end of the year, and get those repairs undertaken right now so that you're incurring that expense. What are some examples of the kinds of repairs that people might be doing in their rental properties that they can claim for?
Oh, painting because of tenant damage, generally sprucing up the garden, just not replacing things in their entirety, but just bringing things, the original bit, back up to scratch. That's probably the way to describe it.
All right, so that's the first one. Bring forward any repairs, any spruce up, anything you need to do it now before the end of the financial year. What is the next one?
Okay, you like this one, Margaret. Depreciation schedules. If the property was built after the 16th of September 1987 and you haven't already got one and you don't know the original building costs, then it's probably worth getting the depreciation schedule before the 30th of June so that you can claim the costs of the depreciation schedule in your 2022 tax return rather than wait another year.
So in addition to having those on-paper deductions then available for you to claim, you can also have the costs of having it prepared. If someone hasn't had a depreciation schedule produced already and they haven't been claiming it already, can they go back any amount of time and claim retrospectively, or is there a limit on that?
There's a limit, so you can automatically go back 2 years, but for 4 years, you have to be able to either show that you're a beneficiary of a trust or that you own a rental property jointly with someone else. Otherwise, you're limited to the 2 years. And you have to argue with the tax office to get that 4 years too, because they'll just automatically only give you the 2 years.
Okay, all right. So 2 years if you haven't already done it, but get it done. Don't think that it's too late, because you can get those 2 years. And it could be quite valuable to you. You'd be quite surprised that even an older building, as long as it's built after a certain date, may have some of that on paper deduction available for you. Julia, what's the third thing?
You might want to consider interest payments in advance, but I'd only recommend that if you've got an exceptionally high year, such as a capital gains tax in this event in this tax return. And before, you just can't pay the interest into the loan account. You have to actually contact the bank and get them to charge you the interest for that year before you can claim a deduction for it. Otherwise, it'd be treated just as an extra principal repayment on the loan.
Yeah, that is a bit of a trap, because I have known property investors who think they're doing the right thing. They go and make a big lump sum payment before the end of the financial year and think that they're prepaying their interest. But you actually have to get the bank to calculate it, let you know how much it is, and then make that prepayment, Julia.
Yes, it has to be categorised as interest, not a repayment of principal.
Okay, yeah. Now that is a good one, but there's some traps here, of course, Julia, because if you prepay interest, then you're just taking your deduction away from next year, aren't you? It would be a good idea to be sure that you know that this is the year you really want that extra deduction in.
Yes, either a high tax year this year, or maybe next year you're going to be on maternity leave or something like that. So smooth it out, because once you've paid a year's interest in advance, you're stuck on that bandwagon. You've got to continue to pay it in advance just to get your normal tax position.
Yeah, and I would also think that if you, and this is just a thought that I just jumped into my head then, but if you were selling a property and you had a capital gain that you know was coming in, possibly even prepaying interest on a number of your properties might help to not offset the gain per se, but a capital gain gets tacked onto you and paid as your top marginal rate of tax, doesn't it?
Yes, well, once it's got the discount, it's just added to your taxable income, so you could consider it that last bit, and that's going to get the highest marginal rate that you are subject to.
Yes, yes, certainly. If you knew that there was a capital gain coming in, and in the following year, and you had that money available for you to prepay that interest, I'm just thinking this one through a little bit further, because as I said, it's a good idea that I've only just thought of. Just say it was March in the year and you just incurred a capital gain now. I guess you could then bring forward and pay out of that capital gain some interest in that year to offset that gain.
Yes, but you've got to be very careful to match, because you might not have the cash, because the year the capital gains taxed is the year that you sign the contract. You might not get the cash until the following year, and no point in doing it in the following year. So just be careful.
And that's a great tip there as well about the contract. Many people believe that capital gain applies to when they receive the money, so date of settlement, but it doesn't. It applies to date of contract. People fall into a trap there too, Julia, when they think, well, in order to get the discount you get if you've held an asset for 12 months, I can sell it now and just delay the settlement until after the 12 months, but it's contract date.
That's right. Contract date when you buy, contract date when you sell.
Okay. All right. Well, that's our third one. What's the fourth thing to do before the end of the financial year?
Well, it's a matter of making sure that your repairs are deductible, is what I thought was a good point here, because racing out and spending money doesn't always solve the problem. So if you buy plant equipment like carpets, hot water systems, air conditioners, stoves, range hoods, that sort of stuff, they're only going to get depreciated over their effective life unless they're under $300 per owner. So you might be able to get a range hood that's under $600, joint owners, yes, that's worth doing. Otherwise, they've got to be classed as a repair, which means that you're repairing something where the entirety still exists. And that's why you're not going to get it with the hot water system, because you're throwing out the whole hot water system. You would get it with painting because the house, the walls or whatever still exist. But be careful, if the property needed painting when you bought it, then actually painting it's an improvement, it's not a repair. So that becomes an initial repair, which you only get to write off over 40 years at 2.5%. You don't need a depreciation schedule to do that, by the way. You've got the receipts there anyway. That just goes in your depreciation calculation in your tax return.
You know, I do find that a lot of people do get those initial repairs mixed up. They buy a property, they then do a whole lot of what they call repairs and sprucing up. And I'm not talking about major renovations here, but certainly work that they think they're doing as a repair, and then they try and claim it. And I also see accountants claiming it as well, when what people really need to understand is whatever state you bought that property in accounts for the price that you paid for it, or vice versa. So whatever you paid for the property accounts for the price or the state of that property. So if you go and do anything to that, that's not even a renovation, but as you say, painting, or maybe, you know, sanding the floors, or just, you know, doing a few repairs to fix that broken window that was part of the property when you bought it, that is an initial repair because it's an improvement to what you bought.
There's even a case, Margaret, that might amuse you, where they argued, well, we paid top dollar for this property. We didn't know it was going to need this repair, so we should get it as a repair. And they didn't even successfully get that.
Right, yeah, definitely make sure that you know what you're buying. And the best thing, if it's at all possible, is to buy a property that you might be able to get a tenant into and then carry out the work afterward. And I think, Julia, it might even be worth, in those circumstances, maybe giving the tenant a small discount on the rent for the inconvenience so that they're in there, and then you can be carrying out that repair while they're in there. Is that a good way to overcome that?
No, Margaret, it's a question of fact. If it needed doing when you bought it, all you're doing is hiding the fact as best you can. But, you know, in an audit, you'd have to lie to the tax office, which is not on. That's not the way we play the game. You'd have to lie to the tax office and say, oh, no, it didn't need doing when I bought it. And you've probably got a building and pest inspection anyway that will show it needed doing. So,
okay, well, you know me well enough after all these years to know that lying to the tax office is something that I never want to do. And I never, ever want to be on the wrong side of the tax department. It's the one thing, or there's many things, but it's definitely up there on the list of top things that I would never want to do.
Your phone's ringing.
Certainly don't want to do that. I live in fear of an audit my whole life. Okay, we're up to number 5. What's the 5th thing that people need to have ready in order for them to be all ready for their tax return at the end of the year?
Well, they might want to make an extra super contribution. They're allowed $27,500 cap this year in tax deductible super contributions. You've got to include the amount your employer paid in that, but you might want to top it up. You also might not have used your cap last year, and you can use that as well. The point is, if you want to make that super contribution, it's got to be nicely, well and truly settled in the super funds bank account before the 30th of June. So don't leave that until the last minute.
I always find that superannuation is the one thing that is the least understood and the most underutilised. And I know we've got a question tonight about super funds as well. And I was just looking for a little bit of information myself on the weekend with regard to super. And I can recall saying to my husband, if I'm having trouble navigating this and understanding it, imagine what someone who doesn't have a lot of financial and investment knowledge would be like, trying to navigate this whole superannuation rules. I was looking at all the withdrawal rules around taxed components and untaxed components, and I'm sure you look at it and it's all very simple, but you know, the average person really struggles to understand just how that all works. And it's no wonder that people don't contribute to such a very effective way to saving towards your retirement as super is. It's a wonder people really don't get as involved in it as they should be doing.
Yeah, well, they're supposed to go and see a financial planner, but because of all the requirements now that the financial planner has to do such a big fact find, it's going to cost them thousands of dollars to get advice from a financial planner. What I have tried to do is streamline the process, and there is a blog up on the website on how to contribute to super, what you should be checking. But it does say in the big picture, you need a financial planner, because there's so many things to consider that could be unique to your circumstances. And if I wrote all that in the blog, nobody would read it. So
I think, Julia, the trickier part comes when you're thinking about withdrawing. I'm of an age where if I stopped working, I could get to my super. My preservation age is 56, which is well past now. So if I wanted to, I could draw out some super if that's what I felt like doing. But just trying to navigate through the tax component, the non-tax component, and how much tax I need to pay on anything that I do withdraw if I withdraw it is in itself quite a tricky thing to do, particularly when mine is a self-managed super fund and there's another person in that who doesn't have those same preservation requirements that I have. So it gets very, very difficult. But the thing about superannuation, in my opinion, and even if you think you don't have enough superannuation in order to give you a comfortable retirement, I like to think about the marriage between a property portfolio or a personal property portfolio and then a super fund. And I think they really make great partners in that, particularly if you're starting a property portfolio a little bit later in your life, so a little bit closer to retirement, and you're worried that your property isn't going to perform in time, then I always urge people to think about super as that in-between option for them. Once they retire, they can have super that then maybe gives them another 10 years sitting on their property and doing nothing and watching it grow. And once super starts to peter out a little bit during that 10-year period, by then that property portfolio will be just that far ahead again, and then possibly ready to fill the next gap in your life where you need an income.
Yes, if you're holding it for rent. Because if you're holding it for capital gain, you intend selling it at that stage, then you wish you bought it in a super fund in the first place, so you wouldn't have to pay any capital gains tax.
Sure, but let's just talk about those people who, for whatever reason, couldn't have bought it in the super fund, and they want to put it. They've got the capacity in their own name, but not in the super fund. Being able to just push out that time for when you want to liquidate that property so it can grow a bit more, that can be facilitated by that super fund, even if you only have a smaller amount in super.
Yes, okay.
All right, Julia, number 6, we're up to the last thing that you think, or the last most important thing that you think people should be doing before the end of the financial year.
You notice none of these, Margaret, are about running out and spending money just for the sake of it. The next thing, because the tax man only gives you a small percentage of what you spend.
Exactly.
But the next thing is to get all your diaries started. So you need to have them for a month before the end of the financial year. So if you've been working from home, keep a representative sample of how many hours that is that you're working from home a month. With your phone, it's a bit easier because you can go to recent calls and screenshot the last month worth of recent calls, providing they're all saved. That's why I'm saying look at it now. And you print them up, and then you put work and private against it, and you've got your phone diary. And same with even if you're just using the 5,000K method, you need some sort of reasonable method of calculation. So doing a month's diary for the car would be a good idea too before the 30th of June.
Julia, I'm pleased to say that there are now some fabulous apps for the car as well that you can get, and that app directly links into your navigation system so that when you are using the car, you just start the app, stop the app, and then it completely logs for you exactly how many kilometres you took. You just log it as a work trip, and those apps are brilliant. And some of them cost money, and there are a couple of free ones as well, which help you to keep those records of your trips, which are great, fabulous, great idea. Certainly, I would have liked it back in the day when I used to have to keep those logbooks and write them all down, and I'd always forget to do it. It's great to have an app that you just click on when you get in the car and click off when you get out of the car, and there you have the record already made. Just with regard to those working from home deductions, the tax office has made things a little bit simpler during COVID times, didn't they? Where they had a set amount that you could claim as a work from home allowance if you were working from home during COVID.
Yeah, you still need to have a basis to work out how many hours, but they introduced an 80 cents an hour, but you still need to work those hours out. Now that 80 cents an hour, most of the time I find that's of no value to my clients. It's better to go back to the old 52 cents an hour, because if you accept the 80 cents an hour, then unlike the 52 cents an hour, you're not allowed to claim any depreciation for your laptop, any stationery, ink cartridges, or even your phone. So it becomes better value to claim only 52 cents in most cases.
Okay, all right. But if you are one of the people who haven't kept any records at all so far and you can't remember what you've been doing, then at least we have the 80 cents an hour allowance that you can claim. Julie, just switching off to same subject, property investor, but a different avenue. I often get property investors asking me whether they need to register for GST to be a property investor. There's a lot of reasons why they ask me that. What's your response to that?
Oh, don't. No, we're talking residential rents. Don't. If you've got a commercial property, a tenant would probably benefit from you registering. So that's you might do that. But you don't have to register for GST even if your residential rents are over 75,000, because the input taxed residential rents are not included in that 75,000 test. And the worst thing is if you are registered for GST and you go and sell a property that you bought as a house and land package, like you built it, if you go and sell that and you've only rented it out for 4 years instead of 5 and you're registered for GST, you have to give the tax office 1/11 of the sale proceeds on that property.
Right.
Unless you dot a lot of I's and cross a lot of T's. In fact, I've been horrified to find that some conveyancing solicitors are saying to people, you've only owned this property for 4 years, you have to register for GST. And that's not the case. But the minute they get talked into that, 1/11 of the sale proceeds.
Right. Well, we certainly don't want to see that happening to anyone at all. Does that apply to an established property as well, or just those house and land packages and new properties?
Yeah, with the residential property, the GST only applies with the first sale of the property. So if you built the house, then when you sell it, yours is the first sale.
Right. Okay. So if you do build a house and you sell it within, say, 3 years and you've had it rented the whole time, is there no GST to pay?
No, if you're not registered for GST, then you've got to look at the test. Do I need to be registered? Is my turnover more than 75,000? No, it's not, because I'm selling a capital asset. I've not built that property to sell, so it's not part of my turnover. I built the property to rent. The catch is you've got to be able to show the tax office that you did build to rent, not to sell. And so ideally, if you've only kept it for 3 years, you want to be able to show a change of circumstances that forced you to sell.
Right. Okay. Well, certainly I know that if I've built any properties, I have built them to rent. There's no two ways about that. I've never built a property to live in. I mean, I had many years ago, but that was a different circumstance. But all the properties that I've built, and I'm sure that all the properties that a lot of people watching this show have built, they built for the purposes of renting out. So they certainly wouldn't have that problem or come across that problem at all. Now, I want to get to the warning that you really wanted to be able to give viewers today. And you've said to me that you want to give them a warning not to sell an investment property after they've rebuilt. Now, can you start out by just telling me the circumstances under which someone might rebuild an investment property, and then why you're issuing this warning?
Well, it could be because of a natural disaster. So the insurance company gives you a cash payout and you go and rebuild it yourself. You could just decide that this is a valuable block of land. I sell it with a rubbish house on it. I'm not going to get as good money. It's better to build. The point is, in both cases, you could have just sold the vacant land at the demolished stage. You could have offloaded. So the minute you decide to go ahead and build a house on it with the intention of selling, then you're in the business of building a house to sell. So that house becomes part of your turnover. it's more than 75,000, so you have to register for GST, you have to pay 1/11th of the sale proceeds to the ATO. You're still going to get the same price for it whether you pay that money to the ATO or not, so it's straight out of your pocket. And also the profit on that build is not going to get the 50% capital gains tax discount because you're in business. You're not an investor at that point in time that you decided not to sell off the land but build a house to sell.
Sounds like a big trap. And I guess if you do have an investment property that burns down or you decide to develop, then you need to have the intention of building it to continue to rent. And if you do sell within that first 5 years, then I guess you need to be able to prove that you had a change in circumstances then that made it necessary for you to sell the property.
Yes, ideally. Yeah.
Yeah. So I guess, you know, what's a good change in circumstances if you lose your job, I guess, or you can prove that you're not earning enough and you needed the cash, or there was a medical emergency or a sudden overseas holiday you needed to take.
Interest rate rise, divorce.
Any more? Just so we know.
I've had one client successfully apply for a ruling where they argued that they built 4 townhouses to hold as rentals, but they had all these problems along the way and they had a price blowout, so they had to sell one because the numbers didn't stack up because they'd spent so much money, and they were successful in that. I've also had ones that weren't successful in that argument.
That certainly makes sense. I mean, having just written the book Diary of a Small Property Developer, I can tell you that that's exactly what happens. Costs do blow out, no matter how well you plan, and it's certainly a very legitimate excuse in my opinion. Now, thank you so much for that, Julia, so far. Certainly lots and lots of information there, and don't forget that if you are looking to get a little bit of help or you've got some questions, there's a great section on the Ban Tacs website under Ask Ban Tacs where you can get lots of answers very, very quickly. I know Julia gives fabulous advice and feedback through that site. So make sure you go there if you've got further questions about what you need to do by the end of the financial year. But for now, we're off for a break. While we're gone, you can still send those questions straight to me at pam@mypropertytv.com.au or via a direct message to me on Facebook, and I'll make sure that at some time we get an answer for you. Stay with us. We're off for a short break, and we'll see you when we come back.
Setting and forgetting your property portfolio can be just as bad as never getting started at all. If you're not staying on top of interest rates, loan structures, tax deductions and current rent returns, there's a good chance that your portfolio is underperforming and you're losing money. Whether you have a large property portfolio or you're just starting out, monitoring your properties is just as important as buying them in the first place. Destiny's Finance and Portfolio Monitoring Service will not only oversee your rentals to ensure they're always achieving the best possible return, it will identify when you're ready to invest again and ensure that you always have the best and most cost-effective loan products available. And with more than 25 years of experience and billions of dollars in finance applications completed, you can be sure you're in safe hands with the experts in the business, Destiny.
Go to destiny.com.au to find out more, or give us a call on 1300 My Destiny.
Thanks for staying with us. You're watching Property Investing Matters, and joining me tonight and talking about what you should be doing to prepare for the end of the year, and also answering your questions, is tax guru Julia Hartman from Ban Tacs Accountants. Now, you can join us with your question, and if we answer it on the show, you'll receive the book of your choice from any of my books. Now, let's see what we have with our questions this week. Julia, thanks for hanging around to help me answer them. Let's go to the first one tonight, which comes from Lynn. And Lynn asks, "Hi team, I've just been told that my laundry, shower room, plus an adjoining bedroom will be redone, all new, covered by insurance. Do I need a depreciation schedule done for this?" It's a very interesting question, Julia, because often people get a fair amount of work done by insurance, or they get a cash payout in order to do the work themselves. How is that all managed?
Oh, okay. Well, it's very differently depending. So with her case, the insurance company is actually doing the rebuild. So that's what they said, isn't it? Yes. So there's definitely a repair to the existing building, so that the building's the entirety. So it's a repair. There's no depreciation for that. It's just ignore it, keep on going forward. What's happening is the building is now worth more money. So the real benefit she gets will be taxed as a capital gain when she sells, but there's nothing because the insurance company is paying. On the other hand, if they give her the cash and she does the rebuild, then we've got issues because it's never going to be exactly expended. So she's got to match it. So they give her the cash to repair the bathroom. What are we doing? We've got a shower and a laundry. She does that repair for, let's say, $10,000. They might have given her the $10,000 to do it this year. She doesn't get around, as you do these days, to doing it until the 23 financial year. So she doesn't have to do anything in her tax return with that $10,000 cash until she gets into the next year. And then she puts the $10,000 worth of repairs in as an expense, and she puts the $10,000 insurance proceeds in as income. So it's a successful recruitment, they cancel each other out. Now the catch is if the repair costs her $11,000, then she gets $11,000 deduction with $10,000 income, so she gets to effectively claim that extra $1,000. If, on the other hand, she gets the repair for $8,000, she's got a $2,000 profit effectively here. She does not have to put $10,000 in as income. She only has to put the amount that's been recouped. So she puts in $8,000 as income, claims the $8,000 expenses, cancels itself out, and the remaining $2,000 just comes off her the cost base in the capital gains tax calculation one day.
It's quite complicated. It certainly highlights the very valid need to keep very, very accurate records for your entire property ownership. I think a lot of people don't keep good enough records, and therefore this is where they can really fall into a big trap. Julia, with regard to repairing or rebuilding a bathroom, if there's things like new, say, wall-hung vanities and things like that, are they not fixtures and fittings then, or are they part of the setting for income producing and therefore considered part of the building?
Well, vanities is a classic question because it's all about whether they can be removed easily without damaging the building or damaging the item. And generally, you would think that a vanity, so
well, it's attached to the wall, so you're going to make a hole in the wall if you try to remove it, I guess.
I think so. But what I'm trying to do is remember Don Jam's case, because this is the question without notes. So with Wilma Don Jam, she actually replaced the vanity and wanted to claim it as a repair. And so it was the other way around. She didn't want to depreciate it. She wanted to claim it as a repair. So she had to find an entirety that it was part of. And her argument was successful on the basis that she still used the old pipes. So she hadn't actually completely replaced the vanity in its entirety. Now, I don't think that would wash in most cases, but she got it through on that. So it was a repair.
Good pun there, Julia. Doesn't wash. We're talking about bathrooms.
Didn't even think about that.
Well done. And on that note, let's go on to the next question. And the next question is from Lisa. And Lisa asks, hi, Julia, can you explain the 12-month prepaid expenses rule and its implications, pros and cons would be appreciated. Now, we've already talked about prepaying interest, but what about prepaying expenses like your rates and anything else that you know you're going to have ahead of time?
Right. Well, rates are a bit difficult, same with Body Corp. You can try, but you've got to consider that you might already be 6 months in advance. So don't go and pay 12 months in advance, because once you tip over the 12 months, then that's a pro rata, so you don't get anything in advance. In reality, you just don't usually get away with it with rates and Body Corp. And with land tax, it's specifically locked in to the year in which the land tax applies, whether you're in arrears or in advance. So if you're in arrears, you might have to go back and amend a previous tax return. That's locked in. I think the only thing that's really worth considering is interest payment in advance. But as we said, as another trap I want to point out to Lisa, that we were talking before about either a low income year the following year or a high income year in the year you do it. If there's nothing, everything stays the same. I want everyone to stand back from these payments in advance, in particular this year. So this financial year is the last year we'll have, according to what they're telling us now, this is the last year we'll have all those nice little tax offsets that can get you, your $1,000 back or whatever, in fact up to $1,500. For the next 2 years, they won't be there. So effectively, if you have the same income in both years, you're going to have more tax to pay on that income next year and the following year. So it might be worth waiting until then. And in particular, the 30th of June 2024 year might be the year to make payments in advance, because as we said earlier, you're just borrowing, it catches up sometime. And come the 1st of July 2024, they bring in this new 30 cents in the dollar tax rate. So if your income's between $45,000 and $200,000, you're only going to get taxed at 30 cents in the dollar. So that's effectively a low income year straight after that.
Yeah, so really, unless you've just got a very, very valid reason to prepay those interest expenses, you might just be bringing forward trouble or delaying, kicking trouble down the road that you certainly don't want. Next question comes from Jason, and Jason asks, hi, Margaret and Julia, is there a threshold or dollar limit for maintenance or repairs done to an investment unit? Is the amount a total over the financial year or per item? I'm not sure what Jason's asking, but I guess he just wants to know, how much money can you claim on repairing your unit?
Yeah, well, of course, you're going to set off bells and whistles if you claim too much, and they might come looking, but there is no technical cap. But remember we were talking earlier on about, is it a replacement in its entirety or is it a repair? Now, your hot water system and your stove and that replacement in its entirety, they have if you can keep it under $300 per owner, then you get to write it off immediately. So that's the only cap I'd be concerned about, maybe a $600 range hood with a jointly owned property. It's worth trying to keep it over that. You'd be crying if you spent $650 and then you've got to write it off over 10 years compared to getting it that little bit cheaper.
Yeah, it's a really good tip, actually, and a great example of how shopping around is certainly a good way to go. And the other thing that I like to do if I am getting any of that kind of work done is I like to source the items myself rather than have the guy doing the work source them. Because when the guy doing the work sources them, he generally will just charge you X amount. So, for example, someone's doing a kitchen, they might just charge you $10,000 to do the kitchen and give you a bill for $10,000. But if you source all the PC items yourself, and then you can shop around and get good buys for them and bring as many of them in under the $600 yourself, then you've got that deduction straight away on those items, Julia.
Well, better still, Margaret, you'll love this. You see, unless you're doing a substantial renovation, which is a huge thing, if you're just doing up a kitchen and the builder buys the stove and the range hood, then you don't even get to depreciate it because it's second-hand by the time you get it from the builder. The builder's the first owner. You know how you can't claim second-hand plant and equipment now?
That's crazy. I had no idea that that's how it would work. And I know the property that I just built a rental property actually in New South Wales. And I did go to the trouble of buying all the PC items myself. I had an arrangement with that builder. He let me buy them all myself because I had some really good links. I knew that I could get some good stuff. He liked what I got so much that he said he was going to be getting the same stuff himself, but I got really good discounts on that stuff, and he gave me a credit for what he would have charged me for those things, and it really ended up being great. And I'm then the one with the receipts for everything.
Yeah, you're fine with a brand new, by the way. I just want to make sure people don't get the wrong idea there. If it's a brand new build or a substantial renovation, then technically, apparently, the builder owns it as trading stock. So you're the first owner. That's okay. I don't make the rules. That's the ruling.
Yeah. Hey, I'm not sure that any sane person makes tax rules, Julia, because we go through them on this show often, and very often I don't understand how they came about or what the thinking is even behind them. And I can remember getting a ruling of my own years ago on something that I wanted to do, a way I wanted to structure my financial situation, which benefited the tax office. It benefited me, but it benefited the tax office. And my ruling was, my idea was rejected under a personal ruling. And the result, if I had done it the way they wanted me to do it, was that I would get bigger tax deductions every year. And it made no sense to me at the time, but that's the way it went. Let's go on to our next question, and it comes from Anne. And Anne says, "Hi, Julia and Margaret. Using self-managed super fund for property development, what options are available?" This one's a tricky one.
Anything to do with self-managed super funds is tricky. I have a rule for clients that want to set up a self-managed super fund. They're not allowed to whinge for 6 months. That's all the loops you've got to go through, and everything just takes longer. They go, "I've never had this when I bought a property before." Remember the 6-month rule? Go away. Anyway, but that aside, it gets even worse with property development because you're really pushing those rules up against the wall. The first problem is you can't change the nature of the asset that you borrowed for, which means when you do a property development, you do change the nature of the asset. So you can't borrow for the asset, and you can't borrow for the whatever you're doing to develop that asset. So you've got to have a lot of money inside super and get under all, the contributions caps and that sort of stuff. Fortunately, now you can have 6-member super funds, so maybe you can drum up enough people. I do like self-managed super funds as a way of bringing non-related people together because it's audited every year, so there's not much chance of a fight. I'd rather them do that than have a company or a partnership, because there's a what you'd call, I suppose, a referee in the auditor, that this is what's fair and there's strict rules. But anyway, if you can't raise enough money, then you can get involved in entities that would do the development for you, and the self-managed super fund would have some sort of equity interest in that entity. But the development still can't be used as security for a loan. You'd be looking for security elsewhere. And you've got all these problems about the super fund can't make any abnormally high profit or abnormally low profit. It just got so many rules. Mm-hmm. And what I'd suggest, obviously, it's get a specialist involved, but not just a specialist in self-managed super funds. When you're talking property development, you need someone that's got the property development experience as well, especially if you're setting up these interposed entities. So, and we have a guru just like that at our Toowoomba office, by the way.
Excellent. You definitely need a guru when it comes to self-managed super funds, because they are a minefield and you can't do anywhere near as many things as you would like to do with them. So while I do support a self-managed super fund, used correctly. In my case, I use mine mainly for my non-property investments because that's much cleaner, much easier to track. But I do support a self-managed super fund, and I certainly support super funds. But once you want to do things with property inside that self-managed super fund, it's difficult. And once you want to build a bigger portfolio of properties, it's difficult as well. There's all those rules around, having a balanced portfolio in your super fund. If you set up a super fund just to buy one single investment property, then all of your eggs are in one basket, and that's certainly not a balanced strategy at all. So there's a lot of rules that make it very, very difficult that you need to be aware of before you go ahead and set up a self-managed super fund. And certainly don't set up a self-managed super fund because someone who is trying to sell you a property suggests it as a good way for you to get property if you're unable to buy it in your own name. I've seen that happen all too often.
Absolutely.
Next question comes from Sharon, and Sharon asks, "Hi Julia, what are the tax implications for gifting funds to children, especially when considering the longer term care fees for them?" I guess, Julia, you and I had a very brief discussion about this, and because I didn't have any feedback from Sharon on this question and I couldn't get more information about it, I wasn't sure, but we both figure that what she's talking about is she wants to give money to the kids, but later on they might have to pay for her care somewhere. Is that what you were thinking she might be asking?
Yeah, I would think she was worried about the aged care fees test, and pardon me, they do have the same rules as the pension rules where you can't deprive yourself of assets, they'll be counted anyway. And it's exactly the same thing. You can give away $10,000 per financial year. Over a 5-year period, you're only allowed to give away $30,000. But if you deprive yourself of a big lump sum of assets, then you're deemed to still have them, but that only lasts for 5 years. So assuming we're just at the moment looking that mum's trying to help them buy a home or something like that, and it's a long way down the track before the aged care fees, it won't get caught then.
Okay. If it was closer, say mum was already retired and potentially in receipt of even a part pension, then she's just strictly bound by those $10,000 a year and $30,000 maximum rules as to how much you can give away. I've seen this happen where someone who was already in retirement got a fairly large proceed from a house that her sons had helped her with that house. They'd actually given her money along the way to help her to renovate that house, but their name wasn't on the title or on the loan. And so she wanted to share that money back with those children when she liquidated the house. But because of this $10,000 a year, $30,000 maximum rule, she was caught under that, and it was considered that money she gave to them, which ended up being about $100,000 each, was considered to be still hers.
Yeah, and it's not the end of the world. She might still get the pension because the deeming rates are rather low, but she'd be deemed to be earning income on that $200,000.
Yeah, and I think it affected her pension by, I think, around about $80 or $90 a week in the end, which can be a lot of money when you're on the pension. So, yeah. All right, this next question is a capital gains tax question, which we always love or hate, as the case may be, and it comes from Karen. And Karen asks, "Hi, Margaret and Julia. A brother and a sister inherit a house from mum and dad in 2012. Mum and dad originally bought in July 1985, and it was their principal place of residence. The sister's husband pays $140,000 and buys the brother out. The house was valued at $280,000, so he buys the brother's 50%, the sister's husband. The sister and the husband rent the property out into 2020 and then sell it for $520,000. How is the capital gains tax worked out?"
Right, well, the sister inherits her half of the house at market value at the date of her parents' death, so that's her half of the $280,000. The transaction between the brother-in-law and the husband is at market value too, regardless. So if we assume that all happened around the same time, we end up with a starting cost base of $280,000. It doesn't matter what the husband paid the brother, it's a matter of market value because it's a related party transaction. Then we'd add on maybe a small portion of the share of probate costs for the sister's portion of it, the legal costs for the husband to buy part, the stamp duty that the husband had to pay, and of course we add on the selling costs, and then if they had claimed any building depreciation, we'd actually reduce the cost base by any depreciation that they were entitled to claim. Then any other expenses that sometimes get included are probably have been claimed as a tax deduction all the way through the ownership period, so I haven't addressed them. So, but you might, if they've done improvements, you might add that to the amount, and then you deduct all this from the 520,000 sale proceeds and divide it by half for the 50% capital gains tax discount, assuming they hadn't been non-residents for tax purposes at any time, and then split it between the two of them, and hopefully it doesn't have too bad an impact.
And they essentially, I guess for tax purposes, Julia, the sister and the husband are really deemed to have acquired the property as at the same date if it all happened around the same time. And the brother who was bought out, because he sold it within that 2 years, wouldn't have had any capital gains tax obligations. Would any of those calculations have changed had the property been bought by the parents after September 1985, or because it was their principal place of residence, does that not matter?
Yeah, because it was their principal place of residence, you get exactly the same concessions.
Okay. Now, just for the viewers and anyone else with a complicated situation like this, had that property been owned by the parents after September 1985 and it was a rental, then things would be a little bit different.
Oh, yeah.
How would they be different?
Oh, okay. All right. So after 85, so what, can we just remove the husband buying it? Because it just unnecessarily confuses it. So after 1985, purchase, it's been a rental the whole time. The deceased wasn't living in it when they died. So you inherit their capital gains tax problems too. So you start off with whatever the deceased paid for the property and you carry that through. You can see how this is really unfair when you give one child the rental property and one child the home you're living in. So they get a whole, so it goes through. And so what are we saying? Let's say mum and dad paid $100,000 for it in 1986 and held it as a rental all that time. You just pretend that you were in the shoes of mum and dad. You have to write back their depreciation, which, no, you wouldn't.
All very, very complicated. Julie, just one last question on this particular question in regard to the house being valued at $280,000 as at the time of death. What kind of evidence do you need that that valuation took place? And if it didn't take place, what are your options?
Right, well, you normally have to give a valuation for probate, so that'd be on record. What your problem is that valuation might have been low and you'd much rather it be higher. At any time, you can get a registered valuer to go back and give you a valuation, and if you've got that, that's your trump card. The tax office isn't going to argue. But generally, I was speaking to a valuer that worked for the ATO, and he said they sort of accept that most valuations will vary by up to 10%. It's not an exact science.
It does raise another question, though, Julia, that just say, in this circumstance, the transaction that took place essentially had a $280,000 value because the husband bought from the brother at $280,000. But what if you get that valuation and the valuation goes back and says, well, it was really worth $380,000 at the time? Does the Office of State Revenue then come after you and say, hang on a minute, you didn't pay enough stamp duty on your half because you only paid stamp duty on $140,000. It was really valued at $350,000. You should have been paying it on $175,000.
Well, I suppose in theory they can. I've never seen it done, and I doubt whether they would. You know how? Yeah.
I know they're not going to go looking for something that happened 20 years ago, but yeah, just theorising around all the things that could possibly go wrong with these kinds of arrangements. So, most important thing is at the time that you do buy a property from a related party, if you are buying it at under market value at the time, you do have to declare the market value and have evidence of that market value really for the Office of State Revenue. And a real estate agent's opinion is not sufficient. It has to be someone who has, the real estate agent might also be a valuer, but they have to be a registered valuer in order to be able to give you that. And you need to pay stamp duty, whatever the value is, not what you're buying it at. Very, very important lesson for investors to understand. Next question comes from Elisa. And Lisa says, "Hi, Julia. Rental property has a fire insurance which pays out. You then build a new home on it. How is the capital gains tax calculated when you come to sell? Purchase was $520, insurance payout of $330, cost of new build $600, sale price $1.1. Oh, Julia, do you get many of these? It's a wonder you don't have a permanent migraine."
I love capital gains tax. In fact, next time I come on, I'll have to put in a plug for my lovely little spreadsheets for keeping all the right records.
Well, you're putting it in now, Julia.
Yes, I haven't finished writing it, so it's coming. Stay tuned. But that's the trouble. That's what I'm realising. People need to keep elaborate records that they haven't even dreamt of are necessary. And imagine what your executor's going to go through if you haven't kept them. Anyway, next lecture over. On to this. So what happens is, as long as the rebuild costs more than the insurance proceeds, okay, and that's nearly always the case, or it's the same. So let's just stick with that. So what happens is you still stick with your 520 cost base for your first element of your costs, your 520. Then you add the difference between the insurance proceeds and the rebuild costs, which is 270,000. So now you've got 790,000 as your cost base. Now let's assume that your selling costs are 20 grand, so that brings you up to 810. But during that time, you've claimed building depreciation of 30,000. So you're back to 780 as your cost base. And that means the capital gain is 320,000, because 1.1 million less 780 is 320. Now, the trouble is, like we said before, which I think we've done to death, so I might leave it alone, you wouldn't sell it straight away, or you're going to lose 100 grand in GST, and you wouldn't get the 50% discount on all of that 320,000 profit.
Well, pretty clear to me. I'm hoping that for our viewers that they also follow that. But yeah, look, the most important thing that I can point out here is that before you do anything, talk to your accountant. Don't go and incur a capital gain and then ask your accountant to solve it for you. Because once that contract is signed, whatever is, and it is too late to do anything about it. There could be better ways to approach this capital gain, but they need to be approached before you make the sale, not after the sale has already been made. Most important thing to know. Julia, we just have one question left, and it's from Sharon. And Sharon says, "Hi panel, as a person of retired age, my accountant tells me that I am no longer a business person, so I cannot claim my travel in relation to property. Your thoughts on this?" Just straight up, Julia, my thoughts on this is that Sharon might need to get a new accountant.
Well, she's misunderstood what they've said.
Well, it's not beyond reasonable doubt that an accountant could make these comments, because I have heard things from accountants that are just completely wrong.
Okay. But the accountant could have said, if you're not in business of owning rental properties, you're no longer allowed to claim travel expenses, as you know, what came back in 2019. So the question is whether she is in business of having rental properties. It's got nothing to do with her age or retirement. It's a question of whether she's in business. And there's two ways of testing that. That is, how many properties have you got? Nice to have about 9 properties. You can have less if you're doing Airbnb. And also that you're actively involved in managing them. So you might arrange the repairs, interview tenants, do the bookkeeping. Then you're allowed to claim to travel for your properties, because this is a business enterprise you've got. It's only residential passive investors that are mums and dads with only a few properties that can't claim the travel. Further, if she's got a commercial property, she's allowed to claim for travel to that commercial property, even if she's only got one.
Yeah, look, Sharon, a couple of years ago, the tax office removed the ability for you to go and visit your investment property for the purposes of anything as a travel expense. And of course, the idea behind that was because people were buying their investment properties in all sorts of beautiful holiday locations, going up for holiday, and then claiming that trip as a tax deduction. So they removed the capacity of you to do that. And Julia, you can own more than 9 properties and still not be in the business if you largely hand over the property management and the arrangement and everything to someone else. You don't need to be in business as well. Is there an advantage to being in the business of rental properties that you think, if you do have a bigger portfolio, over just being a normal property investor?
Margaret, question without notice. There is a blog on my website that breaks this down. It's called Taking Care of Business. It goes through all the pros and cons of getting it. If you are in business, one of the advantages that comes to mind is that you could say mum and dad own the property 50-50. You could actually argue to give mum all of the income and not to dad, so there's those sorts of things that come with being in business. You don't get the small business concessions on the capital gain. There's no way you can get around that. If you've got a lot of properties, you know how you can't transfer residential properties that you already own into a self-managed super fund? Well, you can if you've got a lot of properties because they're the business assets. They're solely used in a business. And not all of them are coming to mind at the moment, but they are all listed there. There's 7 issues that address the difference, and they all are teeter on whether you're in business, but there's a different definition of when you're in business.
Excellent. Well, certainly that's a blog that is a very, very valuable one for investors to go and have a look at. And I know I'll be there as soon as we hang up from this show, having a look at that blog myself. Well, that is all we have time for this week. And don't forget, you can watch past shows free, either on the My Property TV website or by going to destinylive.com.au and signing up for a free account, which enables you to have a look at the hundreds, probably thousands and thousands of hours of TV we've done. And Julia, you feature in a lot of those hours. So there's certainly any question that you have about property investing, you can just type into a search bar and it'll bring you up a piece of footage that shows you the answer to that question. And as I said, Julia has answered many of them as well. Now, if we did answer your question tonight, send an email to pam@mypropertytv.com.au with the subject book prize. Tell me your name, address, which question you asked, and this week, which book you would like, and your book will be sent straight to you. Thank you, Julia, for being here tonight and for answering all of the questions.
Thank you for having me, Margaret. That sounds a fantastic search engine you've got.
It is. It's a fabulous search engine. It's all the footage has been keyworded. So if you put in a keyword like capital gains tax, we'll probably see a lot of you in the results. But all of the related video to that keyword comes up. So where we either answered it or dealt with it in some form or another on every show I've ever done, including all my Sky News shows too. So it is a great resource, and it's one that, people can find there. But it's always great to have you along. I know you always say to me, oh, you didn't give me notice about that question, but my experience with you is I don't really have to give you notice, Julia. You always know the answer anyway. So thank you so much for being so generous with your time. You can find Julia at bantacs.com.au, which is bantacs.com.au, where, of course, there's an abundance of helpful material on their Property Investors page. And Julia also answers questions in the Ask Ban Tacs section. Now, remember, our new Property Match service is here, and it is a great new way for you to get all the support that you need to buy a property which is just right for you without the expensive price tag of some property advisors. Now, just drop me a line if you'd like to know more, or go to mypropertymatch.com.au, which you can see there on your screen. Have a great week, and I will see you back here soon.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.